Welcome to Corporate Bridge overview of the financial markets. In this module, we will quickly go through the specific industry jargon and go through exactly what is the sell side and the buy side, what is exactly investment banking as a management, sales and trading, as well as hedge funds and alternatives. A merchant bank, the traditional definition, the old school definition, is a bank that deals in international finance and makes loans and underwriting activities. Well, that's a mouthful, but we really care about now is that the mainstream definition. Specifically, a boutique investment bank that has access to capital for principal investments, whether they get it from the partner's capital or they get it from an affiliated private equity fund or venture capital fund. A merchant bank, again, is a boutique investment bank, very specialized to begin a middle market who also has access to begin through another fund or affiliate vehicle in which they can make actual principal investments. So now you can get the best of both the worlds. Why is that? You can cherry pick the best years from your deal flow and then decide to invest using own capital and to try to make a additional value added proprietary gains. So that is where a merchant bank, if they have access to capital and they do it right and they know the industry very well, they can also make a fair amount of money as well. The investment banking hierarchy usually starts at the very bottom. This is your analyst at the very bottom who does all the groundwork, works on pitch books and memorandums, comms and financial modeling, and there's a lot of industry research and a lot of internet as well. They are literally sitting in front of Excel at 4 o'clock in the morning. Now, the associates who oversee analysts have a lot more responsibilities, so they are the ones who can have to take responsibility if something goes wrong, because the analyst can always push blame to associates and say, I was supposed to do this. Ultimately, the associates are supposed to check the analysts and start thinking about the additional things past the groundwork and start thinking strategically. So again, the associates oversees the analyst who will do some of the financial modeling and analysis as well as start to interact with the client and execute the transactions. The vice president to be considered middle management here. We're actually focusing more on transaction execution as well as the strategy of the deal and what needs to be done to get the deal done. The product development as well, think of ideas as well as start actively managing the client, and the ultimate job is to make sure the associate and analyst are doing their work properly. This vice president is supposed to have a fair amount of deal experience who can then go ahead and decide and figure out, hey, are we doing something wrong or are we not doing something wrong? Do we need to do something about this from a different angle? Presumably they have seen a lot of details in the past before. Moving up the hierarchy, we have the principal, senior vice president, or the director. Depending on, or you may even say the executive director sometimes, depending on a specific bank and what the hierarchy is, and the title is, this is a step above vice president below the managing director. The principal, senior vice president or director is responsible now for industry coverage as well as developing the products alongside the vice president, as well as starting to develop relationship management and to start outsourcing deals on their own. Then you have the ultimate on the top of the managing director. The managing director is responsible primarily for client coverage, what I call a highly paid salesman. They have a lot of relationships in the business, in the field, and in the industry that they are able to rely upon. The managing director is not necessarily supposed to be a finance guru. That's where the principal, vice president, associates, and analysts come into play. These guys down here primarily do transaction executions, whereas the managing director on top is primarily responsible for getting the deal. Doesn't matter he have the best and the brightest, the best investment banking, you must get the best deal. However, that also means they do a fair amount of travel, whining and dining with the clients, and you might also have the head of the group who oversees the entire group, whether it's the industries or product, and they took the lead, the report to the head of the investment banking. They are more of an executive that they oversee and is responsible for the entire P&L, the profit and loss of that particular division. And in a nutshell, that is what the investment banking hierarchy is. Traditionally and typically, the analysts who have a 2 to 3 years rotation or 2 to 3 years as an analyst usually have hired straight out of the undergraduate college. The associate would either be considered as an analyst promo who is asked to come back as a third-year analyst and then eventually to a fourth-year associate if they make it there, as well as straight off the business school with an MBA. The vice president is typically an associate who has been promoted because they are again on the core in terms of execution of the deals. Now the principal and the senior vice president typically might be a vice president that has been promoted or someone who has come from the industry with not that many years or client experience, but ultimately again the managing director is responsible for bringing in the clients. So from that perspective, 2 to 3 years as an analyst, go back to best school, come back after best school as a first-year associate. You may get up to anywhere between 3 to 5 years, and then you might decide to continue staying within the investment banking hierarchy or not. Progressively, as you move up the rank through hours of course, also get a lot better.